In this week's video, we'll review the latest charts to help us answer the question: unabated bull, painful retracement, or resumption of the bear market? The bull-bear roadmap charts that we originally presented on January 11th and the charts that we presented on January 25th allow us to compare 2019 to both bullish and potentially bearish cases. We'll be moving very, very quickly. More detailed concepts can be found in this January 11th video, in this January 25th video. In the January 25th video, we covered a relatively rare cross when the 100-day simple moving average in blue crosses below the 200-day moving average in red, when the 200-day moving average is either downward sloping or flattish in nature, as it was on January 17th, 2019. We covered 21 similar cases, including 1953, 1956, 4 cases between 1957 and 1966, 4 more cases between 68 and 73, 4 between 1977 and 1987, a set between 1990 and 2007, and our 21 similar periods also covered 2010, 2011, and 2015. And from a historical perspective, roughly 81% of these cases had somewhat of a significant retracement following a similar cross, telling us that if we followed the median path in the present day, hypothetically, the S&P 500 could have traded down to 2332 in April of this year. And if we followed the average path of those 21 cases, 2244 around Independence Day. And as we noted in a February 11th, 2019 short takes post, it's extremely important for us to understand that an 81% probability of something happening is not a 100% probability. And in that post, we also covered the 1971 V-bottom breadth thrust rally, a similar breadth thrust to one that was seen in January of this year. And while a V-bottom is rare, it's not unprecedented. And while a V-bottom occurring when we have a relatively weak trend profile is rare, 1971 says it is not unprecedented, reminding us that we should be open to and prepared for bullish outcomes near the 200-day moving average in 2019, as well as bearish outcomes. And under our approach, the purpose of the bull-bear roadmaps is absolutely positively not to predict or to extrapolate, but to make probabilistic assessments based on the facts that we have in front of us. And those assessments need to be adjusted when the facts in front of us change. For example, in last week's video, on Friday, February 8th at 11:06 a.m. Eastern Time, the S&P 500 was down 22 points, and this was the look of our chart, price coming up to a flattish 200-day moving average in red, and it looks like it was rejected in a fairly firm manner. Thus, during last Friday's session, it's hard to make an argument that this look here looks discernibly different from this look here in 1994. But if we fast forward to late in the session a week later at 2:44 p.m. Eastern Time on February 15th, this was the look in last week's video, which is quite a bit different than the look that we have a week later. A week ago, we looked a lot like this. Now we're starting to differentiate ourselves from this concerning look here. The trend strength model, which we've talked about in the past, is one of the major components of the CCM market model. During Friday's session, we had a trend strength reading of 15. You can see what happened here near the 200-day moving average with a trend strength reading of 7. Price was firmly rejected. We had a 5% retracement. Thus, this indecisive look here and this relatively low score here is reflected in our still mixed allocation. And that's reflected from a defensive perspective. From a growth-oriented perspective, the look of this chart is also reflected. This, as it sits now, looks a little bit better than this. This is a more constructive look with price above a 200-day moving average that's trying to turn back up. From an incremental perspective, this is a week ago. We look a little bit better today, and we've moved a little bit more towards looking like a bullish case. Hence, some adjustments to our portfolios this week. Prudent, data-dependent, and measured. But as history tells us, and as we've noted in past videos, clearing the 200-day moving average for a short period of time with a relatively low trend score doesn't necessarily mean that we're out of the woods yet. In this example here, the 200-day moving average is in orange. We also know that it's possible, even under a bullish situation, that we could be forming some type of bottoming pattern. And in this hypothetical left shoulder, the S&P 500 traded above and below the red 200-day moving average numerous times. This is the look of the S&P 500's generic moving average cluster profile on December 7th, which would be in here. We have a similar look in the present day with some notable exceptions. The biggest difference is the slope of the 200-day moving average. Clearly down here, much more flattish, and even trying to turn up here. But we did clear a flattish 200-day moving average here, and history tells us right now we're still not out of the woods. But this does look better already than numerous cases that were unable to clear the orange 200-day, which gives us a very, very good example of how we use the bull-bear roadmaps. 200-day moving average here, sharply rejected. 200-day moving average here in red, sharply rejected. Our roadmap on February 15th looks better than those two cases. And the present day look, peaking above the 200-day moving average, looks a little bit more like this indecisive move here that was followed by a good things happening scenario. The purpose of the roadmaps is not to extrapolate. It's to continue to monitor what's happening in the present day and compare it to the historical cases, both bullish and bearish cases. There's no question this chart on an incremental basis looks a little bit better than it did a week ago. And in last Friday's video, somewhat of a rejection look at the 200 looks very, very similar to this rejection look here, significant retracement, and similar to this rejection look here, significant retracement. As of February 15th, again, we have some incremental improvement. This looks better than this, and this, the longer we hold above it, will start to look better than this. Doesn't mean we extrapolate this. We continue to monitor it and compare. And after this low here, the model has picked up incremental improvement along the way, including incremental improvement over the past 5 trading sessions. Our first small incremental add was back in late December of last year. And in some cases, we made our 5th incremental add during Friday's session. During Friday's session, we ask, are we allocated in line with the weight of the evidence tracked by the model? And the weight of the evidence includes many more data points above and beyond the trend strength model. That is 1 component, an important component, but only one component of the model. You can make an argument that this little indecisive look here and then a move above the 200-day looks a little bit like this indecisive look here. This indecisive look here, this is just a closer view. This indecisive look here, and this indecisive look here. And the fact that we're above looks better than this point here. And the longer we hold above, it will look better than this point here. And this point here on February 15th is already better than this point here. Why? We're coming up to a downward sloping 200-day here in orange. If you zoom in on this in the present day, it's actually starting to turn back up. Continue to take it day by day. The more this chart morphs into something like this, this, and the more the data improves, the more we can shift from a defensive posture to a more growth-oriented posture in an incremental manner. We said we would learn something either way. The look of our chart on February 15th, this right here does have some nice characteristics, but it's difficult to say with a trend strength score of 23 here and a flattish 200-day that we're necessarily out of the woods. However, look at the 200-day here, how long it's clearly been down before this attempt. That's not the case in the present day. We've had pretty much a flattish to downward look here, and then a flattish to turning up look here. But this number here, and this trend strength score of 23, tells us to continue to take a measured approach. Downward sloping 200-day, a little worse than the present day, but the trend strength score relatively low here and not discernibly different than the present day. Similar situation here. Can't throw all caution to the wind with a trend strength score like this. The purpose of reviewing these charts in recent weeks was not to try to find reasons to defer decisions or to look for reasons to be bearish. We're looking for guideposts. Remember, we compared the present day chart to this look here. If we come back here, the S&P 500 has made 6 discernible and positive steps. Number 1, we cleared this potential form of resistance here. Number 2, we blew right through this potential area of resistance. Number 3, we blew right through this downward sloping trend line. Number 4, we blew through a line similar to this one here, the blue line. Number 5, we came back and retested this breakout and this downward sloping trend line. And number 6, rallied and made a higher high. So 5 and 6 now look better than this point here, where we broke the trend line, but we're unable to clear this line here. So really 4, 5, and 6 look better than this point here. It doesn't mean we're out of the woods. It's just incremental improvement. This looks better than it did down here before we cleared any of these potential obstacles. So we can add in some trend strength scores here. When we cleared the downward sloping 200-day here, trend strength score was all the way up to 80, quite a bit better than the present day. When we were rejected here, we had a very low trend strength score of 9. By the time we made it over to this side over here, trend strength score was much, much better. 2015 case, weak trend strength score of 17, bad things happened. After a bottoming process, you can see the data improving, and over here on the right side of the screen, our trend strength score is all the way up to 100. This looks markedly different than this here, and this score relative to the present day score doesn't tell us that we're bearish. It tells us to take a measured approach and to also understand the odds of a retracement and size our positions and exposure to growth accordingly. A low trend strength score speaks to probabilities, and it's one input, not the only input. And low probability outcomes are far from zero probability outcomes, which is why in that February 11th short takes post, we talked about the need for maximum flexibility. Low trend strength score, V bottom, and then really good things happened in this 1971 case. Weak trend strength score here in the 2011 case, followed by almost a 10% give back, telling us in the present day to be prepared for a give back, which is quite a bit different than waiting for a give back or expecting a give back. It is within the realm of possibility, just as a bullish move is within the realm of possibility. And under normal circumstances, if we're patient and we quote unquote waited for the trend strength score to improve, would we have been too late in this case? The answer in this case was no. At the point where the trend strength score had risen to 82, the gain after that point was over 69%. Similar situation in the 1980 situation. If we scaled in, and we're still scaling in when the trend strength score was 80, was it too late? In this case, the answer is a definitive no. From this point here, the S&P 500 gained an additional 456%. As covered on short takes, a move above the orange and flattish 200-day moving average, especially a relatively short duration move. This is 8 trading days, 2.41% above this point here. Did it mean we were out of the woods? Absolutely, positively no. The 2015 rally attempt on the left side failed. The 2016 rally attempt succeeded, which is why in the present day we've scaled in, but we have not thrown all caution to the wind. It's still within the realm of possibility that we could see a significant give back or drawdown. It's still possible the present day looks like this, and it's also possible the present day continues with a V move from a starting point down here with a very weak profile. This is the trend strength score up here. We have to make decisions based on the weight of the evidence. Back to the 2015-2016 case. Typically, bottoms are a process. Was it too late if you had scaled in between this point and this point here? In this case, the answer was a definitive no. From this point here, which is this point down here, here, and here, really good things happened. But with a trend strength score of 15, we also have to be aware that approaching a 200-day moving average with a relatively low trend strength score, this point here is this point here. It's still within the realm of possibility that really bad things could happen. But notice, from a comparison perspective, it wouldn't take much to discount this look here in the present day. Haven't thrown this look out yet. We'll learn a lot more over the next 2 weeks or so. Back to the 100, 200-day cases. 1973, we clear, in this case, a clearly downward sloping 200-day moving average in red. We have a relatively low trend strength score. And here's our cross here, and here it is in our table. And while this 200-day moving average unequivocally looks worse than what we have in the present day, we also have to respect clearing the 200-day and staying above it with a relatively low trend strength score tells us we need to have a very, very specific exit strategy. If good things happen and we don't need to execute relative to the exit strategy, that would be great. A couple more cases anecdotally from the 100 and 200 day analysis, 1977 and 1981. In 1977, we come to a downward sloping. This looks worse than this. But we still clear the 200-day moving average. We have a relatively low trend strength score, higher than the present day. What happened next after this point here, which is this point here? After clearing the 200-day moving average, the S&P 500 lost an additional 14.4%. Measured, prudent, and data dependent. How about the 1981 case? Again, 200-day moving average looks a lot worse than it does here. However, we did try to test that 200-day, and in this case, we really never closed above it, which tells us the present day just recently has started to discount this look here. But with a similar trend strength score near the 200-day moving average, what happened next in 1982? The answer is an additional loss of over 14%. Prudent, measured, and data dependent. The more this can morph into the bullish look, the more risk we'll be willing to take, and the more improvement that we see in the hard data, the more incremental steps we can take. You can see here in 1994, we did get one close above a flattish 200-day with a low trend strength score. In this case, we had a 5% retracement. The allocation that we have currently and our position sizes account for the fact that our positions could see retracements or givebacks anywhere between, let's say, 6% and 11 to 13%. I don't want to spend a lot of time on this. A couple of points. You can find this table on OddStat's Twitter feed. Here is the Twitter handle. You can find the chart and click on it and make it large like this. Quick takeaway. Retail sales came in very, very weak. It's rare to see a report similar to the report that we got for the month of December. This data set tells us to be open to a relatively significant drawdown sometime in the next year. The median drawdown in the historical cases was 22%. Hence the term measured. Also, this tells you that the next 5 trading sessions, whether we stay above the 200-day or go up or down, really doesn't mean a whole lot in the grand scheme of things. We know from past videos that the plunge that we saw out of the September-October highs in the S&P 500 from last year was a relatively rare and low probability event. Here's another one, but in the opposite direction. You can pause this and look at the chart in more detail. This is the NASDAQ in blue. This is a sentiment measure here. Sentiment, very, very low levels late last year, which makes sense. Low levels here. It took roughly 9 months in this case for sentiment to move from low levels to high levels. We just saw basically the same move, not in 9 months, in 1 month. This is based on newsletters, and I'm guessing, it doesn't say on the chart, that it's based on newsletters that were published at the end of January. This is a huge move in a short period of time. It's a drop like this in the NASDAQ, and a V move like this, and a very, very rare move like this in sentiment. These are the type of low probability situations that we're addressing with the Bird Strike project. To use another analogy, every once in a while the market runs a low probability trick play. We want to do everything we can to be as prepared as possible for those low probability trick plays that the market will run again sometime in the next 20 years. This project is going very, very well. We're already uncovering a ton of useful information for these lower probability events that will happen again in the future. Just because we've had some difficulty with some of the trick plays or lower probability events doesn't mean that the model is broken or the core principles are obsolete. And here's an anecdotal example of that. Here are the top 10 holdings of one of the most successful hedge fund managers on the planet. U.S. stocks, emerging markets, gold, bonds, U.S. stocks, long-term treasury bonds, corporate bonds, and emerging market bonds. This is someone that has access to arguably the deepest research bench on the planet. And the themes that are reflected in this portfolio here are basically the identical themes that we covered in a February 4th short takes post. You can pause your video player and read these little blurbs from that post. These blurbs align almost exactly with the concepts that are reflected in this portfolio. And in this post, we covered emerging markets, one of the top holdings. We discussed why gold-related investments were coming back into favor. Gold. We noted that bonds were still holding their own. Bonds in the portfolio. And we even got as specific as saying emerging market bonds, one of the top holdings in the portfolio. Our model is sound, and the Bird Strike project is going to help us immensely with those low probability events. Common sense tells us if you're running a long-term trend following model, a low probability market crash followed by a V bottom is difficult for a long-term trend following model. That doesn't mean that we can't find ways to handle that type of situation in a more effective manner in the future. Hence, all the work that's going into this project. We try to give a balanced view in these videos because we want to make the right decisions. We're not concerned about being great forecasters. We take it day by day. We do not use charts to forecast. We use them to assess the current situation. From a bullish perspective, remember back in December, the market hated the automatic pilot comment relative to quantitative tightening. And in December, the Fed really threw the market nothing, no bone, nothing. And after the V move off the low, it might be pretty easy to forget just how bad things were. CNBC, December 17th. This is before the Fed meeting, before they raised interest rates and said the quantitative tightening program was on automatic pilot. Both the Dow Jones Industrial Average and the S&P 500 are on pace for their worst December since 1931. 1929 to 1932 was not a good period in the stock market. From a positive perspective, the Fed continues to pull a complete 180 on these topics. We had a significant development just this week. MarketWatch, December 2019. Fed Chairman Powell said he thought the balance sheet reduction plan would last until 2020 or 2021. Fast forward to this week. After that horrible retail sales report the Fed made sure they had somebody on CNBC within an hour. And this is the most specific clarity that we've got on this topic. December, Powell said he thought it would last till 2020 or 2021. Now the Fed is saying the balance sheet runoff or the quantitative tightening program should end by the end of this year. This is a big shift and a bullish shift. And like the bearish factors, it is one factor. Doesn't mean we should be blindly bullish. But just like the charts have improved, this is a significant change from the month of December. And this is even a significant change from 1 week ago, because this is the most specific they've gotten about when the program might end. We did a little more digging on the similar breadth thrust. You can find this post on our blog, Short Takes. Here are the cases with the similar 10-day breadth thrust. And if you look at this table inside of the post, this is one of the most bullish historical analogies I've ever seen. These are seriously attractive numbers on the right side of this table. So this week we wondered, if we look at these historical cases and assume that we're roughly 35 days from the end of the breadth thrust, historically, from roughly mid-February in 2019, what type of maximum drawdown could we expect relative to these similar cases? The answer is, looking out 60 days from the equivalent of mid-February of 2019, the average maximum drawdown was only 2.31%. And you can see the numbers are low all the way out to 12 months. So on average, the worst case, maximum drawdown in the historical cases, on average was 3.84%. That basically means we could be fully invested. We can withstand a 3.84% drawdown. That's not a problem. However, the worst case scenarios, 1962, which happens to be the case that we identified in this post as being the best match for 2019. In 1962, there was an 8% drawdown over the next 2 months, equivalent looking forward from mid-February of this year. And in the 1947 case, there was almost a 10% drawdown looking out 6 months. And these scary drawdown numbers here are basically the 1987 crash. The takeaway for us, these drawdowns here, and this data, for the most part, says we should try to get fully invested as soon as possible when we're looking at this data in isolation. But the worst case scenarios tell us that we should also be allocated in such a way and be position sized in such a way that we could see an 8 to 10% drawdown over the next 6 months, and we could see a relatively large drawdown looking out 9 to 12 months. And notice these numbers here mesh up with these numbers here. We monitor such a wide array of data, it's impossible to cover it all in these weekly videos. So let's take a moment to talk a little bit about Friday's close. Some of these statements relate to daily charts, some to weekly charts, some to monthly charts, etc. But you get the point. New highs, new lows. NYSE hit a new high for the rally on Friday. The bank loan ETF, new high for the rally. Regional banks, new high for the rally. Weekly up-down volume, highest level since early October. Semiconductors, new high for the rally. Stocks versus bonds, still moving off a bounce at a logical level. Equal weight technology relative to intermediate term treasuries. Weekly made a new high for the rally this week. Home builders, very, very close to closing at a new high for the rally this week. Value line geometric index has retaken key levels. Our VIX rate of change charts still look good. Same goes for our S&P 500 weekly rate of change charts. S&P 500's weekly chart has also cleared numerous forms of possible resistance and is holding above them. Many of our long-term charts that we covered last year still look constructive. And our global Dow chart that we've covered in these videos in the past has also reclaimed key levels, and it almost looks like a false breakdown occurred late in 2018. Deterioration on these charts could begin at any time, but we haven't seen it as of Friday's close. We'll head into next week with that flexible, unbiased, and open mind. Linking back to our original question, one of the best ways to understand, are you allocated properly? Or to help you answer, am I taking too much risk? Or am I underallocated? Am I too conservative? If we're in an unabated bull, do you feel uncomfortable or feel like you can't deal with that? If there's a painful retracement coming, does your current allocation make you feel uncomfortable? If this turns out to be a bear market rally and an awful bear market followed by a series of lower lows is on the way, how uncomfortable does that make you? Well, for us, based on what we know and the way that our portfolio has been constructed, we feel like we can deal with all three scenarios. And given the uncertainty and the broad array of bullish and bearish information that we have in hand, we feel like that's a good place to be. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.